All right, well, welcome to our presentation in conjunction with FLYA. We've had quite a bit of success and enjoyment being a part of FLYA for pretty much since the last 3 or 4 years. So we thought we'd take some time and present, rather than do educational material, thought we would talk very specifically about Boomerang, what we do, how we do it, those sorts of things. Of course, there's a bunch of our insights and those sorts of things mixed in. So we hope that y'all will find this enjoyable and worthwhile. So just to introduce the team and who will be talking, we have David Nielsen from our team. He does the lending. I'm the principal, and then Alan Marsh does much of the operations and does commercial real estate. So we'll cover today the same thing that you got advertised or disclosed to you or as part of the marketing. Why does hard money lending exist? How has it evolved? What are the current opportunities there? And what do we do it and how do we do it? And then a little bit about the fund structure, and then a little bit, of course, about some of the things go wrong. So Alan, why don't you go ahead and start us with why hard money lending even exists?
Yeah, appreciate that, Rob. Thank you. And it's a pleasure to be here with everybody this morning. Typically, banks, want to lend to businesses that are creating a cash flow, and which is exactly what hard money lending isn't really doing at the moment. So really then what is going on is that you have an asset and that is not producing cash flow. And then therefore we have if you go to the next slide there, then we have a person or an individual that is looking to do that loan and looking to do a loan on the asset, which is exactly what we are looking to. We are looking to the asset, not the cash flow of that business. So one of the things that we also look and try to understand in the risk of everything is to look at a J curve. And a J curve is that you buy the property at one point, and before you know it, you start to take away value there by changing things, taking down some walls, redoing the roof, and those type of things. And so you bring down that value of that asset to begin with, and then you work its way back up as you do the rehab and repositioning to get us back to a value that we have underwritten to. One of the other things that's interesting as you consider the fix and flip and the before and after is to consider, why do banks not do this? And, banks have a charter, they're under, regulatory requirements of what they can and can't do. Again, we are just looking towards the asset. Yes, we have an owner or a borrower that you sign and have personal guarantees on, but we really look to the asset, that if we have to take a property back, which we don't like to, but if we have to, we know what we're getting into and that we can work with that asset when things are all said and done. All right, let's see, next slide there. Rob, we'll go ahead and turn that over to you as far as that's with.
So we thought we'd talk a little bit about then, so that's why hard money lending exists, and a couple of things about that. It's interesting to note a couple of things we do not do. So we are business purpose loans. So we only lend to businesses. We are not commercial. We always talk about a bright line and a wide gulf distinguishing us between us and any sort of consumer at all. So we thought we'd talk a little bit about the evolution of the hard money lending business. And really, I'll talk a little bit, and then David, we'll kick over to you just a little bit to talk about, kind of since 2010 or so. But back, this industry has existed for a long period of time where people have bought homes and then rehabbed them and then sold them. And that's pretty normal. It's kind of a value added. What got normal was this big bump that you see in 2004, where you had speculators buying houses. And they were buying houses not with the intention of adding value or doing anything other than buying it and then selling it on to the next guy. And of course, that worked for a little while, and then mid 2008 or so, that stopped working, and we ended up with a significant pullback. And that pullback, even during, we were lending all during that period of time. Remember, we're making 6-month loans. So, and the majority, you can see that the meltdown took 4 or 5 years. So there was still plenty of opportunity for borrowers to buy a home, fix it, and then sell it at a higher price because of the value added within a 6-month period. So, but one of the things that evolved in that space is the foreclosure process. People buying off the steps of we used to go down to the courthouse steps, and there would be quite a crowd there. And buying a home out of foreclosure is not as easy as it looks. You got 2 main problems. Number one, you've got the buying process, right? Can you get down there? Can you find out it? Can you outbid against all of these other people? There would be hundreds of people trying to buy these things, and just navigating that process, knowing which desk it was going to come off of, that whole thing is problematic. The second problem with the buying out of the foreclosure process is you cannot get a traditional loan for that. Title, at one point, the reason title exists is because title accepts money and does not release that money until title has come in. That's what the title process is. When you buy out of foreclosure, at one point, the court has both your money and the title. So a bank will not lend into that. Bank will only lend against title. So that created this opportunity for foreclosures. Again, you had speculators significantly involved in that, where they were trying to buy very, very cheap. And that very, very cheap existed because of the inefficiencies of the foreclosure process. And then they were just selling it back cheap. So they would still be making a spread. It was a turnover model. Now, since about 2010, 2011, 2012, really our guys are adding value. David, you want to talk a little bit about how they're adding value?
Yeah, and we're gonna talk about this
Yeah,
more later in the presentation. But yeah, I mean, our borrowers that are going out there and buying these properties today, in order to make the profits that they have to add value. So in different markets, adding value is different. So in Colorado, someone can't afford a house, and so what they do is they add an ADU, an accessory dwelling unit, which is a mother-in-law's quarters, another unit that they can rent out. And so that's one there, or adding a garage that a lot of the homes don't have. Here in Arizona, you have adding square footage in order to have another bathroom, another bedroom. And so, in today's market, the rehab is no longer, putting lipstick on a pig and putting it back out in the market. It's more than that. They've got to put some work in, know what the market really is needing, and go ahead and turn that around. Especially, it's hard because in today's market, there are people that want smaller square footage, but you still have to add value. And how do you do that? Well, maybe in that house, it's opening the house up and making it a more, a usable model for the home, for the buyer of today's generation.
Yeah,
Hey,
absolutely.
David, do you see that your investors and your borrowers, do you see them as speculators or truly as investors as they look at opportunities?
So they truly are investors, just because they can see what the market's doing, and they're not trying to be the next new thing. They really are just trying to meet what the need is in the market. And so, there's definitely people that are looking for the speculative side, but ours are, they understand the need in the market. They understand that there's no supply for that need. And so they're going to go and meet that need.
And part of the interesting thing here is, the graph that I've got up now is one of the reasons that we're in this thing is because we quit building homes. So in that meltdown, just entirely, we quit building homes. There's still significant demand. So we need to create it, and we need to fix that somehow. And one of the ways that we create that is through these rehabs. And just the average age of the housing stock in the US continues to be very old. And the problem, we'll talk more about this a little bit today, but nobody wants those old homes, and they don't really want them for 2 reasons. One, we always think about the aesthetics, right? It doesn't look right. It's not on trend, all of those sorts of things. And those are some of the things that David talked about, kind of putting lipstick. That's the paint and the carpet and those sorts of things. But there's also the homes are not. There's a livability. There's a performance, right? So maybe we want more open home structures. That was something that we saw generally, 2015 and 2010, all of those. Now we're tending to want some private spaces, but we're doing some work from home. So there's a whole livability thing. There's also, we got to update the HVAC. We got to check out, the plumbing. If the plumbing is 40 years old, it needs some work. The roof, if the roof is 40 years old, and nobody likes to live through those things. And then on top of that, we end up with all of the smart home and all of those sorts of things. So the homes, the inventory that we have, we don't have enough inventory. The inventory that we do have is old, and that old has problems with both aesthetics and with performance. So that's kind of where we are, and gives us the opportunity set to lend into this even more. A couple other interesting things we talk about. Where does the demand come from? Where does some of the end demand come from? This is the U.S. Census Bureau. They do an annual home ownership deep dive. They do it every other year. So the last time they did it was in 2019. They haven't released that yet. So you'll see some of these statistics look a little bit old, but they're up to date. Just handling a question real quick here. Comment on rates, term and clarity, the borrower, commercial. These are commercial borrowers. This is not commercial real estate. This is single family residential. But these are the borrowers. These are business borrowers. So they've got to own a business. And again, it's a bright line and a wide gulf. We do not do consumer at all. So that's how that breaks down.
Yeah, it's the non-owner occupied dwelling unit.
Yeah,
absolutely.
And as questions come in, I'll just keep popping on them. So where does the end demand come from? End demand comes from this significant age group. Under 35 just does, and this has been consistent for an extended period of time. Under 35, you're not married. You may or may not be married. You may or may not have kids, but you really haven't gone into the household formation and those sorts of things. So once you go into household formation, you want to own a group. Under 35, you just aren't owning a home. And so all of a sudden, when you're 35 to 44, you can see the purple line, not much home ownership. And then all of a sudden in the black line, everybody suddenly starts owning a home. And indeed, that's what's going on. We talk about the baby boomers are the ones, the population distribution. The baby boomers are the bulge at the top. The millennials are the bulge at the bottom. The assets have to get transferred. The assets that have to get transferred are not the assets. A baby boomer house is not the house a millennial wants, giving the opportunity for us. And just as a reminder, we keep on, many times I think when people talk about millennials, they're still talking about some other group than what they actually are. Millennials are middle-aged now. Millennials, a couple different, this is CNBC has a whole expose on middle-aged millennials. So they're middle-aged now. They're no longer young. They've got health problems. They've got kids. They're trying to balance out work and life. So those are some of the things that are going on with millennials. So the millennials are buying houses. And here's just kind of another interesting way. This is the National Association of Realtors Home Buyer Generational Trends. So who's the buyers? These are the buyers. Who's the sellers? And again, I just overlaid these two charts on top of each other. And you can see that the buyers there, you've got the buyers up at the top and the blue bars, and then you've got the gray bars with the sellers. So that's happening. Another way of looking at this, and this is where we get into a little bit of trends going forward, is the median age. So again, the median age, you've got the median age across the bottom. It's relatively consistent at 30 years old or so. The average in the middle. But the important thing, the interesting thing is the second home buyer, right? Or the trade-up buyer. So they are two different buyers. But one of the things, the average tenure in a home is about 10 years, 8 to 10 years. It moves around just a little bit. But if you're going to buy a house at 35 and then you're going to sell it and then you're going to buy another house at 45 or so, that means that the next trend that we have coming, the next movement in homes coming, is probably the move-up buyer. And just as you know, kind of a context, about 6% of all homes in the U.S. purchased are for an investor buyer. They're not all financed that way, but about 6% of the homes. And then you've also got a couple other trends here going on. You know, how did we get this big push in prices? Well, everybody was moving out into the suburbs, right? So urban is still growing. You've seen a lot of stuff about how nobody's living in urban anymore, those sorts of things. We still have international buyers. We still have young buyers. That's really what the big buyers in urban is international purchasers. That's the plurality. It's not the majority. It's the plurality. It's the largest single group. But you've got the suburban, and then you've got this rural. Rural, you see a lot of this stuff, work from home. Everybody's moving out to rural. That's simply not the case. That's what happens late in a cycle, right? When you get a price rising in the urban area, or you get price rising in the suburban, everybody looks to just move further and further out. So the rural thing is really just consistent with where we are in the cycle. And you also see some of these things, you know, the housing market when is it going to crash? Those are buyers asking those questions. Those are not sellers trying to sell. Alan's going to talk a little bit about that in a little bit. And just to that point, this is Fred data again, Federal Reserve Board data that comes out of the St. Louis Fed. And what we've got here is we've got the red line being low tier houses and the blue line being high tier houses. This is Phoenix only. This is one of the MSAs that does it. And you can see that the low tier houses, the price has been pushed up by about 16% over highs. And Phoenix was really high. Phoenix, that big bulge, Phoenix definitely pushed harder than some of the other areas. But so prices even above the highs, you're at 16%, whereas to the highs on the high tier, you're just barely there. So the price appreciation that we're seeing in the markets generally is at the lower tier, not the higher tier. So Alan, do you want to talk a little bit, this is the data, do you want to talk a little bit about this concept that there are no homes available at all?
Yeah, no, it's very interesting to think about. I mean, the market is obviously at a very fast pace right now when it comes to homes, and the activity level for purchasing the homes is very competitive. Here in the Phoenix market where we're based, it's one of our core markets, and so we follow that market obviously quite closely. But as you can tell, just even looking at a sampling of just the Phoenix city proper, not Phoenix metro area, but just Phoenix city proper, just on Zillow, there was 2,845 homes that were available as of yesterday. And yet, if you were to go on the MLS, which is the next slide shows that, currently active listings in Phoenix proper is 1,730. So then you have to ask the question, where's the difference? Well, the difference comes into, private sellers that are actively involved in marketing their product, not even through the MLS, but through different social media sites, whether it's through Facebook or Instagram or through Zillow, all of these different areas in which they can go ahead and market their homes. What's interesting is that, the title companies are as busy as they've ever been, at least the ones that we talk to. We're extremely busy with originating and underwriting our loan activity that we see on a daily basis. And so, so where are these buyers finding the opportunities? And many of them are coming from not listings, right? They're finding the opportunities by talking to the sellers directly, whether it's wholesalers that are doing that work and digging up those leads, or if it's just private, seller to buyer, just individuals happening to know. In fact, we were talking this morning that even in our own office, 3 individuals had purchased homes in the last 3 months, and every one of them were off-market deals. They were not on the MLS. And so those are where we're seeing some of the opportunities that our borrowers are finding ways to find and seek out opportunities and not have to competitively bid against other properties. I even heard recently from a broker who was saying that it just seems like there's, 100, active people that are looking at every one listing, which is, a crazy thing to think about. Great as a seller, frustrating as a buyer. But it is one of those things that they're having to deal with and work with. Hey, David, I was reading that one of the questions that came in, how have you seen some of what's going on, but compared to the COVID, what happened, what we did, what was our strategy? How did we work through that COVID thing? And are we seeing that as a problem for us now as we market through or continue with our strategies?
COVID was not, COVID has not been a huge effect on the single family market as much as we think we thought it would or think it has. The truth is, on our side, which is the fix and flip side, the short term, our borrowers were not highly affected. Now, what happened is for a short amount of time, it was difficult to get permits passed through the cities because the cities weren't doing that process. And then also just having an inspector come out to look at the property, they weren't sending inspectors out. And so it did slow down the process a little bit. However, it was kind of a 2-month slowdown to their project, which did increase their cost. They paid interest along the way. We out of at the time we had about 400 loans on the books at the moment when COVID came about, and we only had about 5 loans that had reached out, being impacted by COVID, and we were able to work through it. One of them being that we had to work through it for several months, and that was, once again, it was just because of the time frame to get the permits done. It was just at the wrong point in the market, and so honestly, going forward, we're not expecting COVID to be a huge impact on us. Some of the other questions that we'll get to here in a minute, but what's really affecting is pricing, being able to find the right property, being able to find the right product, materials, and being able to.
Let's talk about, because we got a couple of questions, so we'll jump in on that one. Rapid rise of commodities like lumber and copper. Does that represent a risk to the fix and flippers?
Yeah.
And
so
how much of it are we passing through?
Yeah, and a lot of this is coming up in our section of underwriting and how we look at these deals. But yeah, so I mean, pricing, big question. Everybody's asking the same question. Yes, lumber is up. Lumber's up a lot. A sheet of OSB used to be $7.50, and a sheet of OSB today, $58. That's a huge difference. It first went up because of the hurricanes and things going on. That happens every year. And then it just kept going up, and so that has increased pricing. Now, has it affected every material for building houses? No, cabinets are not up at the same percentages. Flooring is very, staying at decent prices, and so not everything's gone up. Now, you should expect on a project for your prices to be up 15% in total of what your project would have been. So how does that work? Well, in the middle of a project, that hurts. If you can look at the numbers ahead of time and plan accordingly, our borrowers are understanding that, and they are figuring that out, and they're putting that into the pricing going for the purchase. So once again, there's the price increase in a home in order to sell it. And so luckily the sales are higher at this point. And so our borrowers are still making a profit on their deals.
And right now, significantly, that plays into our hand. There's a lot more lumber that goes into a new build. So we're behind on the new build cycle, but there's a lot. In order to do a new build, you're going to have probably around 10% or so of your costs in lumber and those sorts of things. Somewhere in there, it's about $36,000 worth of lumber now on a roughly average $300,000 new build house. So to do a rehab is going to have less lumber and stuff involved. So it makes a refurbished home less expensive on a like-for-like basis than a new build. So new build is going to compete against rehab. and that's going to play into rehab for us.
Rob, that's a really good point that you're making there, because there's a lot of new builds that are going on that they're not even locking in that purchase price. I mean, you go in there and you sign your contract, but they don't give you a final price until they get closer to the end, because of that price mechanism and the unknown of some of the lumber costs, and they're just waiting as they go through that process. So that's another unknown that works, I think, in our favor, at least within our industry of the fix and flip, that helps.
So let's talk a little bit about, and David, you want to talk a little, you mentioned that you wanted to get into, why don't you start with origination and underwriting and talk a little bit about that?
Yeah, so getting into here, so right off the bat, so how do we separate ourselves from the others? And part of this, and this will answer a lot of questions that we have right now, but how do we separate ourselves? Number one, it's relationship. We are a relationship lender, and so everything is about the relationship and how we work together. Our name says it, we're partners. And so when we start a deal with a borrower, we are a partner from beginning to end. And so, Rob, if you'll go to the next slide, we're out in the field, we're talking to these borrowers, we're going and meeting them on their own turf, being able to see the properties, being able to have that relationship and discuss with them. And you see several pictures here of whether it be in an event, whether it be being able to spend time with them on the golf course, whatever. We're out being able to making sure that the relationship is what really matters in the end. So right off the bat, that's how we originate. We're finding the right borrowers to be able to originate versus our competitors who are pretty much buying leads, right? So this is a very typical, website of being able to go. A borrower goes to this website, they go in and they put in their what they're looking for, the property they're doing, and then it goes and matches out to multiple lenders. Typically, all these lenders buy the lead, and multiple lenders buy the same lead, and they then compete in order to buy the deal. The problem we see with that is just the relationship. They don't end up creating the same relationship that we do. 90% of our deals have been through a face-to-face relationship or a referral from a face-to-face. That's just how we find our borrowers.
David, how have you been able to find the borrowers in today's market?
Yeah, so it's been a little tougher, right? I mean, with COVID, we haven't been at the events, been able to see them there. However, we are still going to properties. We are still walking properties to see how things are going. But more than anything, it's just been, we've been on referral. So it's been the referral from someone that we've met in the past and continuing to grow those relationships at this point. And of course, we are doing marketing. We're doing that side as well. And once we meet someone, we spend a lot of time on the phone with them, understanding what their needs are and who they are. So that takes us into underwriting. This is where we spend a little bit of time to understand who our borrower is and understand what we're getting into. So number one is who the borrower is and their experience and character. Experience. We're not technically looking for the 1 to 4 guy, the guy doing 1 to 4 deals a year. We do those. We're not looking for the guy that's 9+ a year. And we're looking for the guy right there in the middle, someone that does 5 to 8. Why is that? Well, 1 to 4, they're not really experienced in being able to know how to get from beginning to end on the project yet. They haven't run into all the hurdles and figured that out. The 9+ guys, well, they think they control their pricing, right? And so they go out and they push down lenders until they get the rates that they need. Whereas the guys that are doing 5 to 8, they have figured out the market, they know what they're doing, they repeat over and over again, they're looking for higher profit margins, and they just keep operating on that model. And so they've come up with a model that, they McDonaldized it, so it's the same, repeat over and over again, and they keep going through that. Second is we look at capital, and so we look at what they have as a net worth. Rob, still back on the last screen, sorry. So we're looking at what they have as a net worth, what their capital is in the bank, in order to understand, are they a strong enough borrower to be able to purchase and go through this deal. And the last one where we spend all of our time, to be honest, is in the asset. We look at the asset and we look at what's going to get them from beginning to end. So what is the asset? It's the property as is, what the current value is. It's the property when it's complete, the after repair value, and then how we get there. This takes into account the budget. So what we just talked about being that they go over budget based on their lumber, making sure that, hey, from the budget you provided of $60,000, can you get from beginning to end on this project? What does it take to get there? And so, but understanding what what that asset is. And Rob, I don't know, are you able to go back on slides here?
Nope, sorry about that. All I can do is go forward.
Well, so one of the things is so valuation, that's a big part of it. So a couple different things that are out there. One is there is a lot of websites that produce a value such as Zillow, Black Knight creates one, CoreLogic creates one. All these companies use algorithms and they come up with a way to value the property based on what's out there. Well, one of the examples I was going to show you is that you can have a value of showing online a value of $400,000, $415,000. It was a $505,000 value and somewhere in between. We then took the property, we ran our values against it. We came in with an ARV of $525,000 on the property. So we're higher than every one of those. However, appraisal came in at $535,000 above us. The borrower stated an ARV of $550,000. In the end, the property, when they were done with the fixing up the property, it sold for about $555,000 is what the final sales price was. And so we spent a lot of time understanding what the prices are and in order to get from beginning to end on a project.
David, a couple questions coming in. All of our loans are first position. So back when Alan was talking a little bit about, absolutely, we look to the asset first, but so all of our loans are in first position and we do get a personal guarantee. So always first position. And then a couple questions. The reality TV, do you see much impact in borrowers or the borrowing mix or anything from reality TV?
No, we really don't.
Yeah.
It's a hype. It actually is. It's great. It helps our market. It helps a lot of people want to come in and put money into this market. If anything, it does bring a couple more people that do not make money on a property. It gets a few people excited that possibly shouldn't be flipping a property.
Yeah, absolutely.
Yeah.
And then moratoriums, the foreclosure moratoriums, that sort of stuff. The foreclosures, broadly speaking, the foreclosures, people keep talking about foreclosures are coming, foreclosures are coming, foreclosures are coming. It's coming off such a low base that we do not see a significant impact. We'd love to see more foreclosures coming. But it's just not the case. And the reason that it's not the case is no reason other than there is so much home equity in it. We can show you charts off Fred and those sorts of things, that there's so much home equity right now that people have no reason to walk away from a home, right? A foreclosure, you walk away from a home because there's negative or there's low or negative value in it. That's just not the case right now. And it's getting more and more. So,
And Rob, just to that point, you see them go into the foreclosure process, but the thing is, people are coming and buying them before foreclosure, which is actually great for the market. And so, being that the moratorium's there's a few that are affected by that. Don't get me wrong; it's not like it doesn't have an effect, but a lot of them are being purchased prior to that foreclosure date, anyways.
Just the points that Alan made.
Yeah, but the foreclosure market itself, I mean, it hasn't been a significant part of our business either, though, right, David? I mean, if you
Not
look
now.
Yeah, so different types of the cycle and where it was, right, early cycle, and then but yeah, right now it is marketing. Our borrowers are out there sending postcards out, they're sending letters, emails until someone finally sells them the house, and it's right now it's marketing is where they're finding the properties.
Yeah, we're not getting the bank REO stuff and tapes and those sorts of things, and so The next kind of piece of what we do, and we'll get to some of the other questions too, is which I definitely appreciate because they're right on point, which is that a number of people look at, hey, if you underwrite it correctly, a portfolio is just all the loans that you've underwritten correctly. We would disagree on that. A portfolio is a portfolio. So this is the fund summary that we send out to our investors. I'll share with you a few of the metrics that we do on that. So concentration by state, we are right now 51% in Texas, Arizona and Colorado are our majority market. All other markets, we've got about a dozen or so other markets that we're in less so. We'll follow a specific borrower in there with cross collateral and some of those other types of guarantees. But the majority of our book is 85% of our book is Arizona, Colorado, and Texas. We love those markets. We're happy to share with you why. The majority, if you go in the lower left, the concentration by type, we do a little bit of bridge loans. The majority of all those is a cosmetic flip. So the cosmetic flip, our guys are adding value, but it's beyond paint and carpet and those sorts of things. But it stops shy of needing to pull permits. So you can see where we've had some, David talked a little bit about pulling permits and some of those sorts of things can get a little difficult. That can mean a problem when you get into the intermediate. Intermediate means that you need to pull a permit. And construction, we do just a very little bit of construction that's very special. We don't do a whole lot of that. Other people do. We don't like that relative to the J curve, relative to our experience. So, and then you go concentration by size. We want to stay the slide that we referenced before. Guys are making money. There's inventory available. It's where there's a lot of new buyers, those sorts of things. So our average loan is just under $300,000. And average home prices in the US is at $300,000. We also watch our maturities, we watch our top 5 borrowers, we watch a number of those sorts of things. So all of those sorts of things need to come together so that we don't end up with too lopsided on it, too dependent on a single borrower, too dependent on a single state, too dependent on, single size or a single type, or we are creating that portfolio so that we can remain balanced.
Yeah, I think it's good to note that with the lower loan to value ratios and keeping our loan total cost down at, like you said, Rob, of under 300,000, that gives us more loans that we have to manage, which is also a risk mitigator in our portfolio management. It does cause us to have to keep working harder because we're always on that hamster wheel because those things, we're putting out more loans to say other people that are doing $1 million, single loans to a single house in California, as an example. So, we're always having to work to keep that portfolio properly managed and stabilized with the numbers to make the match for us. But, we feel like that's a worthwhile effort.
And here's the thing that I was referencing. This is Adam and Data Solutions. They keep track of a lot of the data on the fix and flippers. These guys doing the smaller loans, they are making money. So it's easier for them. You can see that they've got things going that works. A couple other questions coming in. So that you can see on our thing, our average loan is 67% right now, loan to value. That includes the entire J curve. So we have stuff that obviously is not below, but it's going to be pretty tight on the J curve. But we've got a bunch of stuff that's all the way at the end of the J curve, meaning that, and to the point of needing to manage a portfolio, our portfolio is 67% right now. Our default rate, I'm actually going to let David talk about that. David's going to talk about servicing, and there you go. You talk about servicing.
Well, so servicing is really what matters in this business. In order to get from beginning to end on a loan, the whole servicing team. So this is a picture here of our key component, the key player here in our office. So Gretchen has been here since day one. She's been one that our borrowers, they know her name, they know her voice, and they call in with anything going on, and they know that she knows what's going on with their loan and being able to solve it. And so that it really makes a difference that our borrowers have the same people to call into and who to speak to. So how do we continue to service our loans in order to and take the right steps in order to make sure that these loans are protected? Well, it comes down to a couple things that we find the most important, where some other lenders don't find as important as us. One is having a true health check. Every one of our loans has to make a monthly payment, whereas many other lenders will build into the loan having payments and having a short-term maturity. So we are a 6-month loan, whereas most of our competitors are 12 months. Well, it gives us a health check at that moment in order to show where we're at and what's going on. And so, Rob, if you'll go to the next slide. So here's 2 examples of a health check saving us. So on one of our deals, we had not had a pay. Well, so the payments were being made, but the draws, they hadn't requested a draw in a while. So we sent an inspector out to go look at the property, and this is what the picture on the left is what we showed up to find, is that the property was progressing but not quick enough. And so we were able to sit down with the borrower, understand, find out that they were over budget or they were going to run out of budget. And so they stopped on the project and weren't progressing. And so we were able to solve that, be able to get through to the finish line on that project. The second one, we came up to our 6-month term on our loan, and they were asking for an extension. Well, this was supposed to be a fix and flip, and we went and inspected the property and found that there was someone living in it. It was a rental, which is not terrible. It's just not what our model was. And so we were able to, at that moment, talk to the borrower, figure out a solution to get us paid off, because we're not a long-term model. And so making sure that the loan stays within our model. The second part of loan servicing is that the oversight does matter, and that we need boots on the ground. We've learned that through experience, through mistakes, of course. That's how it goes. But we need someone out there and looking at the property when we need to. And so there's a couple ways we do that. And so on the next slide, we have a couple different inspections that we can use. The first one is our favorite and the most used. It's our Uber driver inspection. We have a guy that $75 anywhere across the country. He can send a guy out. I'm pretty sure he has the inside scoop to Uber. I don't know. And someone shows up and takes sometimes it's about 100 pictures of the property, and it's all in a document that we can go through and see what the status of the project is from a third party. The second one that I show here is we actually have a guy that is a past contractor that is on staff for us, and will fly out and take a look at the property and provide a whole feedback of how things are going. And the last one is something that every one of us has used before. We may just not think of it, but there's inspectors in every market that inspect when you buy your primary residence, and they go through and they're going to provide a report of every little thing that's wrong, because they like to help the buyer get a big Binzer report that to fix everything on the house before they move in. And so that inspection is $400. It does a great job of being able to show what the current status is and what needs to be worked on. This is just an example of that $75 inspection. So if you look, you can see this is just a few pages of it, and it goes on. There's a lot of pictures there. So how we manage them and how we work through them is what matters. And so servicing, as we service a loan, things come up. Remember, we are all about a relationship. And so when the borrower reaches out, we listen and we want to hear what the problem is. And so in this case, this is a property where they went over budget. They used family and friends, and that's not usually the best option for contractors. And so they may not have been the most experienced contractors. And so there was defects, there was things that weren't done right. And overall, the project took too long. And so they ran out of money on the project, and they needed help. Well, the good thing on this property is there was enough value to make something happen and get to the finish line. And then the other one is it was at the right time in the market. if we finished in time, the spring was going to come. And in Colorado, when the spring comes, everything sells. And so we were able to get through it.
And that's a really important thing as far as the relationship lending. If you've got somebody who's just originated loans and then they've sold them off to a third party, that third party has no idea how the loan works, what's going on, any of that. And they really don't have modifications. They will just they'll go straight to, they'll say, look, here was the contract, here was what you were supposed to do. So just to give a little bit of context, about 7% of our loans are going to have some sort of modification. About 3% of our loans are going to have, we'll actually put in foreclosure. Most of those will go to forbearance, and 1% or so will go to foreclosure. We'll talk more about that later. Another advantage of the servicing, so the typical duration of our loans is 6 months, and many of our loans are going to go beyond that. But really, what that gives it gives us a real true up. There's a conversation that has to, hey, look, when we started this project with you, you thought it was going to be 6 months. It's now gone longer. What's going on? And you can have a hard conversation with deadlines. You all know from doing homework and those sorts of things that people tend to wait for the last minute to do their homework. Some of those same sorts of things happen in the home rehab business as well. Having that deadline gives us the opportunity, and then we can go ahead and extend that. So let's talk a little bit too about the fund structure. So there's a couple of real advantages to doing it as a REIT. The income is taxed as a dividend, which is great. You receive a single tax document rather than multiple documents or filing in multiple states, right? If we've got 17 states, you would have the potential to receive in 10 or 17 different tax obligations. The REIT acts as a blocker. And then the REIT also keeps us all in compliance because we've got rules to follow there as well. Armanino is our, we've got audited financials, all of those sorts of things. So another really interesting thing, though, happens in a fund structure. So our average loan rates are going to be in the 12% range with a point or so of origination. That's going to mean that, and everybody goes out and they say, oh, we've got this 7% rate or whatever, but they put fees on fees. The clearing rate in this is about 14% a year. We feel much better being straightforward and transparent with our pricing rather than playing this games or this grid or some of those other sorts of things. So, but your money in a REIT will stay continually deployed. So yeah, you could go out and get 14%. We are 10 to 12%. We're tax advantaged, but your money is also always deployed. So we have about in our fund, we have a handful of guys who used to do this, and they're like, wait, you're going to do all the pain, you're going to do all that stuff, and and my money's going to stay fully deployed. So we've got those. In our fund, there's a question come in, what does our average investor look like? So we've got some institutional investors in there. We've got a number of high net worth. We've got us in the fund. We're about 10% of a little over 10% is us and insiders. And then we have other high net worth. Again, it's accredited to get in. So, and really, so our returns are a little bit higher than others. We don't, again, and the going rate is kind of the going rate. There are some people that are lower rates, but really we look at the fund, all of the fees go into the fund. So origination fees go into the fund. The interest goes into the fund. Any sort of fees go into the fund, and we're paying for servicing. Other people don't do that. Other people originate and they keep the way that their fund is structured. They keep the origination points, and we think that creates a significant conflict, right? All I do, and this is how you get Northern Rock. This is how you get Countrywide Credit, where people are doing the origination, keeping the fees, and then they're loading the fund up with the negative selection. So all of our fees go in, and we pay. And a number of people they pay per file on servicing. That filing, just that servicing, it's $20 to $25 per file. It's not that much. Well, it all adds up. This is really becomes a game of pennies. It adds up to about 300 basis points difference on an annualized basis. We guide to 10 to 12%. So, and this is what our returns end up looking like. The orange line is us. Again, we guide to 10 to 12%. And you've got the S&P. The S&P's beating us a little bit right now, but definitely not on a volatility basis. So a question of whether or not the fund is levered. Yes, we use a very light layer of leverage. We use, so for every dollar worth of equity, we borrow about 30 cents or so. That smooths out the bumps. That's the reason that we do that. We talked about not having money to lend and having to have that perfectly aligned to the sources and uses. We never want to be in a situation where we have to say, well, we want to be in control of being able to say no to a borrower, not saying, oh, we just don't have money. It's a significant part of our value that we provide to borrowers that if we say we're going to do it, we do it. So we definitely, yes, we do. We use leverage. We nowhere near what you're used to seeing on the commercial side in some of the commercial things that Alan would get involved in, but 30% leverage. So that's how we do that. David, do you want to talk briefly about some of the things that go wrong? So here's David, and go ahead and talk about some of the things, and provide a little bit of context for that too.
Yeah, no, well, Rob took a picture of me, boots on, and showing how this works, right? We are the type of, thank you. Boots on the ground. We're out there. We get dirty. We're out there to make sure that the project gets from beginning to end with, being a partner. So a lot of things go wrong. I wish I could say it's perfect. A lot of people want to be invested in this space and they want to do their own loans, and they realize that, hey, I can lend one loan and one of these problems can happen and it's my only property and I'm the one losing money. Whereas the benefit of a pool is to be able to have multiple loans and have, when that one problem happens, that it doesn't hurt the whole fund. And so I'm going to go through just a couple quick examples, I think, as we get through here. So first example, this is one where, they turned it into a meth lab. And so it had to be taken apart and put back together. It was also out in a place far away from our typical contractors, and that's not something that we usually get into. So we had to send contractors that we had out to this area, work on the project, get it rentable, and get it back on the market. And so that was a problem that, hey, nobody wants to deal with, but when you do enough loans, you will come across that problem. The next one is this one's fun. If you can see, this is what we lent on, the property on the left. It was supposed to be a nice, quick fix and flip. However, in one of those inspections to see how things are going, this is what we showed up to find. We found a bundle, a pile of sticks is what was left. And so we called the borrower, hey, this wasn't the plan. What happened? And in this case, we ended up working with him. He did a principal pay down, and he was going to go ahead and construct a home. Well, in the end, he ended up just paying off the loan, which was great. And so we didn't have to get any further down the line on that one.
That was literally like one day to the next.
It doesn't take long to take a house down. It takes a while to put it back up, though. This next one, so these next two go together. So we took, one of our borrowers had a couple properties, and going back to earlier on, Rob and Alan talked about the J curve and where we fall in when you purchase the house versus when you sell the house, but what happens in between that J curve? Well, this is one where we took it back at the bottom of the J curve. The house was torn apart. And so luckily we had Arrow, which is our guy on staff that is a past contractor. He was able to go out to this property and he was able to get through it. And so this is after he went and cleaned it up, got the plumbing up and running, electrical up and running, and just drywalled it. It was enough for us to put it on the market in that area in Texas and be able to be able to list it for someone that wants to buy it and fix it up themselves. Put it on the market. A week later, it was under contract, and so that's a good situation of getting it at the bottom of the market. Now, the same borrower, the second property, he bought this one. We ended up at the top of the J curve, so we ended up just fine because we had two properties, right? Well, this one was completely finished on the market at one point, and he had pulled it off the market. Well, he ran out of money, so we took it back at this point, and we were able to put it right on the market. Now, I wish I could say it was perfect from beginning to end. Once it went under contract, something was found in the inspection. We had a leak. We had a leak under the sink, and so I had to replace some flooring. Somebody threw a rock through a window. Just the things that come up just from managing a property. And so by the time it was done, we ended up doing okay and getting out of that property. But different points in the J curve. And then this next property is fun. As you can see, it was the first time we owned a cow. Well, actually, the cow was gone when we finally got the property back. But when we were taking back the property, there was a tenant living there, and this cow was coming in and out of the basement and using the basement as livable space. The garage, you can see the mess that was left there. A lot of damage to the property. It was not well kept. There was about 7 dogs living there, 5 cats, amongst many other animals. And so we had to work through this one with the tenant, be able to get to where we took back the property. Just in the main family room, we bagged up 99 bags of garbage just to go be taken out. And so by the time we were done, luckily, we do work with wholesalers, and we had a wholesaler that was able to put this property on the market to his group of investors. So sorry, not put it on the market, but list it to his investors. And we were able to sell it in a condition that was not repaired and do just fine. But honestly, our first offers on this property, if we didn't market it out to his investors, was 70 to 100 grand less than what we ended up selling the house at. And so it makes a difference having investors and having the right people in that market who can buy it and see the value in what this house could be.
Yeah. So again, just a couple different, kind of metrics. So David has shared a bunch of our less pleasant ones. So about 7% or so of our loans are going to require modification. That's up pre-pandemic. That would have been about 5%. Now it's about 7%. Some of those David shared earlier are pretty easy conversations. The conversations that are less easy to have, about 3% of them, we're actually going to go into foreclosure. We put them into foreclosure. Generally, they go straight into forbearance. So you've got a problem you got to work out. So, we're doing 1,000 or so, over 1,000 loans a year. But so there's going to be about 30 or so that we're going to have some hard conversations on. There's a number of off ramps for those, right? We can talk to other investors. We can talk to our wholesalers. We can talk to NPL buyers. We've sold notes, NPLs, those sorts of things. But about 10 of those, so 1% or so, we are going to end up taking them all the way through the foreclosure process and end up with them somewhere like this. So 1% of our portfolio, but you can see that these take a lot of time to deal with. And actually, David, I've got one more in here that you can tell a happy story about. I think, yeah, there we go. So there you go.
Oh, yes.
Yeah.
There's the good ones too, right? It's still problem came about. But yeah, this one, there was a second lien on the property. There was
it was just a mess.
It was a mess. It was a mess. The everything that happened on this property, from not paying contractors to a second lien, and we were able to come in, and luckily we were notified from actually the plumber on this one. That's how it all started. They hadn't been paid, and so we went through and found everything else, stopped the project. All that had been done is the demo, a roof, and some plumbing. And we then walked through the property, had inspections periodically just because of where it was. But in this case, we were able to put it on the market, or they were actually able to sell it just before foreclosure. So the second lien this is where it gets crazy, right? Second lien was able to foreclose, wipe out the borrower. The second lien was able to then go sell the property before our foreclosure. And we did make our default interest in order to cover what our expenses were. And so we did fine, and we're out of this one. But there's a need for this product, but the problem is a lot of people did lose money on this. And so it wasn't us, because that's how our loan is set up, right? We're a first lien position for a reason, and that's why we don't get in the second positions. The whole goal is that it's a safe, or it's a secure property in that first position.
Yeah, and I know we're running short on time here, Rob, but the other thing is that as a portfolio, we're able to have a lot of assets that are spread over geographical. We've got different borrowers. It all helps to mitigate that risk of having one borrower to one lender, right? One investor. So, because if something goes wrong with that one loan, and that's all that's tied to your money, it can hurt. But if you're part of a portfolio or a fund like what we have, you're able to really, really reduce that risk overall, and help spread that cost over and share in those wins and losses. More wins than losses, obviously.
Yeah. Yep.
But anyway, that's the benefit of the fund.
Do you want to talk just a little bit more about, I know you talked quite a bit about valuation. You want to talk a little bit more about valuation, being that it's a volatile market?
Yeah, no. So we spend most of our time on valuation and trying to understand a property. So we've had appraisers in here just to be able to teach our team and educate them on the way they value a property versus how we look at it. And we have investors that work for us. We have, our mentality kind of brings that all together, and that's the goal of it. So we look, and we're looking for comparables, right? So a good comparable that will support it. Now, it's really difficult today. We saw this market start to move first in the Austin market, right? We started seeing where the borrower says the value is going to be 550, and we start looking at comparables, and the highest comp we could find was 475, and we couldn't get to their value. Now we look at them, and we really try to understand. We look at what's coming on the market, what currently is on the market, and then also what's sold, and we come to a valuation that we feel confident in. Now, we are a lender. We as a lender will always look at a value more conservative than the investor. It's in the investor's best interest to be more optimistic and be able to go put it on and hit those higher price points. If they were as conservative as us, they probably wouldn't buy many deals. And so we look at it that way. We come back to the borrower, we give them our value, we sit down about it. They give us some points, but we end up lending based on our value. It doesn't mean that's what they're going to hit. It just means that's how we do our loan.
But I think that's a good point, though. I think that with our underwriting and our valuations, as we track the valuations to what the property ended up selling for, on average, we're about 6% below the actual sale price. So from a conservative standpoint, from a risk standpoint, we're a little tighter on our valuations, which actually I think helps us too.
Yeah, no, I mean, it protects us. It protects us in the long run.
So we appreciate the questions. We've got a few more. If you've got, I think we got to most of them, and I've typed out some answers. So the last kind of group of questions, we're about $75 million worth of equity now, pushing around just over $100 million worth of loans. The average, so that's kind of how that works. Minimum investment is $100,000. You can get any of that information through Flya. You can also sign up through Flya, and we will follow up with those sorts of things. And then feel free to reach out to us with any questions or comments or any of those sorts of things. And we'd love to continue to talk with you. So thanks for your time, and we'll look forward to following up with you.
Thank you.